This is Nightly Business Report with Bill Griffith and Sue Herrera.
Oil slick. Prices fall more than 20% from their most recent high as the quick and steep slide in crude intensifies. Record profit. Disney's strong results were driven by its studio and theme park businesses, and now the company has its eye on a digital future. Location, location, location. But in this changing housing market, is buying a home still considered a good investment? Those stories and much more tonight on Nightly Business Report for this Thursday, November the 8th. And we do bid you good evening, everybody, and welcome. Sue is off tonight. In case you hadn't noticed, the price of oil has been falling lately, and it's been falling a lot. Domestic crude is now down more than 20% from its early October peak, putting it squarely in bear market territory. Investors apparently growing concerned about rising inventories and weakening demand, all of which could lead to a supply surplus worldwide. Prices settled just above $60 a barrel today, following a ninth straight decline. That's a long way from $76 a barrel, the price achieved just about a month ago when domestic crude hit a 4-year high. And today, the industry may have been thrown another curveball. Reports saying that a think tank inside Saudi Arabia, which is the world's largest oil exporter, is studying the possibility of a potential breakup with OPEC. Joining us tonight, the very busy John Kilduff, founding partner of Again Capital. Where do I begin? Let's start, though. I'll get to OPEC in a moment, but let's start with the slide here. Put this in context for us here. What's going on?
A market that got all bulled up, as we like to say, Bill, that everybody was on board, or most people were on board with crude oil going to $100 a barrel, primarily because of two things: strong demand that was foreseen, but also the sanctions that were to be put on Iran. It was seen that the loss of that Iranian supply couldn't be made up, wouldn't be made up, and we were going to be facing a supply crunch of a large magnitude here is going into the end of the year.
And now we have these waivers for some countries that can't just turn the spigot off completely.
Well, you want to talk about curveballs to a market. The Trump administration went from talking about maximum pressure and getting those Iran exports to zero to really giving Iran's 8 biggest importers of its oil waivers across the board.
So where are we going?
And ahead of that, Bill, I just have to get this in there. Saudi Arabia, Russia, other key countries boosted exports themselves and production to fill the gap that was supposed to be there. Now there's no gap. Now there's an overflow.
So we've got an overflow. How much lower do we go then, do you think?
Well, this kind of a drop, the steepness of it, the swiftness of it, the magnitude of it, this gets the Saudis' attention, and it gets Russia's attention and others. They are having a technical committee meeting this weekend in Abu Dhabi. Look for, over the weekend, a lot of rhetoric to come out about stabilizing the oil markets, which translates from them to cutting back on output. Look for the Saudis to be dialing back production, the Russians, too, to get prices back up. So we're probably in the process of getting close to a near-term bottom here. I think we have risk on the downside price-wise to about 58, but that should be it because they're not going to tolerate it.
Two quick things. First, what do U.S. producers do about this? We're a big player in this now, too.
Well, that's the problem increasingly, and that's maybe why OPEC may be on its last legs here, because U.S. producers, for the most part, they don't stop producing. You really have to drive them out of business.
Okay, now, what about this report that Saudi Arabia is thinking about breaking up with OPEC?
Increasingly, that is a fractured family. The Saudis are at the throats of the Qataris and the Iranians in particular right now. The Saudis have really basically put up and carried everyone else over the years. Whenever there have been cutbacks required, the Saudis did it. Whenever there was a need for more output, the Saudis did it. I think they've had it. And there also seems to be a reordering of alliances in the Middle East, Bill. Saudi with Syria, believe it or not, Saudi with Egypt.
And what role does Russia play in this then at some point?
And I think Saudi Arabia is looking to divorce OPEC and marry Russia and let those two kingpin producer countries really control the world oil market to the extent they can.
Very interesting.
Very
Lots
interesting
to come
times,
here.
Bill.
John Kilduff of Again Capital. Thanks again for joining us tonight. On Wall Street, by the way, stocks were dragged down by those lower oil prices. Energy stocks, as you can imagine, tumbled. But overall, it was a relatively quiet day after yesterday's huge rally. The Dow today rose by just 10 points, closed at 26,191. The Nasdaq fell by 39. The S&P was down 7, by the way, snapping a 3-day win streak. Now to earnings. Disney reported record profit and revenue for the year and easily topped quarterly estimates. thanks to its studio and theme park businesses. The entertainment conglomerate earned $1.48 a share. That was 14 cents better than estimates. Revenue was up 12% from a year ago to more than $14 billion, and that sent the stock higher in initial after-hours trading this evening. Aditi Roy has more now on Disney's quarter and the CEO's strategy.
Disney announcing fourth quarter earnings today, and the company had strong numbers in its studio category. The company's studio revenues coming in at $2.15 billion versus estimates of $1.78 billion. That's a 50% increase year over year. Disney says that growth was fueled by, quote, exceptional performance of Black Panther, Star Wars: The Last Jedi, Avengers: Infinity War, and Incredibles 2. Disney CEO Bob Iger said the company is investing substantially in original content.
We're weaning ourselves of third-party licensing, which we've already started, so that the product appears on our service and not on third-party services. We're investing substantially in original content, really against what will be all of those brands, but we're making Star Wars series and Marvel series and certainly Disney series and Pixar and original movies as well. And then there'll be thousands of hours of library product.
Disney is also making a big investment on direct-to-consumer offerings to better compete with the likes of Netflix and Amazon. But Iger said it was premature to say whether the company would pursue acquiring the 40% of Hulu it does not own. For Nightly Business Report, I'm Aditi Roy, San Francisco.
And now to China, where the trade war with the U.S. has had investors and businesses on edge. But for snack food giant Mondelez, which has offices in that country, it appears to be business as usual. Eunice Yoon is in Suzhou for us tonight.
The trade war dominates a debate between the U.S. and China, but perhaps to better understand what's at stake, you should try a spicy chicken Oreo cookie. I'm currently at the research labs of Mondelez, the food giant that's behind the Oreo cookie, and the company has been experimenting with all sorts of flavors to cater to Chinese tastes. That would include spicy chicken, wasabi, or even seaweed. Like so many American companies, Mondelez is not moving stuff in and out of the country, but has localized its operations. Its China chief told me that has helped Mondelez do a tremendous amount of business here, despite the trade war.
We are seen as a multinational, but also a company that is rooted in China. Obviously, we like openness as a multinational, and we like free trade as much as anyone. But I would not say it has influenced us a lot. We've got our salespeople here, we've got our factories here, we've got our R&D center here. So we make and bake for China.
He said China generates $1 billion in sales for the company here and is one of its fastest growing markets. So China's becoming increasingly important. Part of that is thanks to the Oreo cookie. Outside of the U.S., the Chinese eat more Oreos than anyone else. The China chief told me to come up with this particular cookie. Researchers were thinking about what flavors are popular in China these days. Apparently, that is savory as well as spicy. Because of all the localization, he said that the company was able to move this product into the market within 4 months, which he described as China speed. For Nightly Business Report, I'm Eunice Yoon in Suzhou.
Spicy chicken Oreos. Time to take a look at some of today's upgrades and downgrades. We begin tonight with Dean Foods, which was downgraded to hold from buy at Jefferies. The analyst says the company's turnaround will take longer than anticipated. Price target $6. That stock fell 0.5% today to $5.97. Square was downgraded to neutral from positive at Susquehanna. The analyst cited concerns over the vacant CFO position, and price target now $77. That stock dropped 9% today. It closed at $75.23. Archer Daniels Midland was upgraded to buy from hold at Argus. The analyst cited strong performance in the company's oilseeds and nutrition divisions. Price target is now $53. That stock rose 0.5% to $48.57. Still ahead, the lucrative rise of DNA testing and some of the controversial issues involved. Today's jobless claims report was just another reminder of how hot our job market is. New applications for unemployment benefits fell by 1,000 last week, remaining near a 45-year low. As you know, strong job growth has led to a 3.7% unemployment rate, the lowest since the 1960s and below the Fed's definition of full employment. In fact, the Fed's Open Market Committee today approved keeping the central bank's benchmark rate unchanged. The decision was unanimous, but there were a few things of note in the central bank's statement. Steve Leisman has details from Washington.
The Federal Reserve kept interest rates unchanged at its November meeting in the range of 2 to 2.25%, but signaled that rates will continue to rise. The market has generally taken that to mean another quarter-point hike in the Fed funds rate will come as soon as December. Markets price that probability in excess of 80%. The Fed had positive words to say about the U.S. economy, noting that the labor market continued to strengthen, that economic activity is rising at a strong rate, and that the unemployment rate has declined. They said household spending is also growing strongly, but they took note that business investment had moderated from its prior rapid pace. The Fed continues to see inflation near its 2% target. All of this sets up a potentially fraught December meeting for the Fed, where markets expect the central bank to hike. But President Trump has complained that the Fed is moving too fast to slow down the economy and undoing the effects of the tax cuts to speed the economy up. Fed officials, though, argue that the current rate is low enough to keep stimulating economic growth. Given the high rate of growth and the low level of unemployment, officials say that the policy rate should actually be neutral, if not even a bit above. But those are questions for December and into 2019. For November, the Fed took a pause. For Nightly Business Report, I'm Steve Leisman in Washington.
Well, there are now only 6 weeks left until the end of the year, so we have the midterm elections, the majority of earnings reports, and today's Fed meeting out of the way. So what will be the catalyst for the market's next move? Joining us tonight, Liz Young is Senior Investment Strategist at BNY Mellon. Thanks for joining us tonight.
Glad to be here.
You're looking at trade to begin with. I mean, we all wonder after the midterm elections what happens to the tariff tiff with China, among other things, right?
Right. Trade is probably the biggest catalyst that the market is going to see through the end of the year. It can either be a de-escalation or an escalation. And what we're looking at particularly is what goes on with China through the end of the year. So there is a chance towards the end of November that some deal is struck. We don't expect that to be the case. So we're actually expecting that trade continues to produce volatility in the markets as we go through the next few months here.
And we see inflation as the number 2 point here that you want to make, and that is tied to trade to a great deal because the tariffs mean increased prices, mean inflation, among other things, right?
Right. So there's a couple different things about inflation that are important to look at. When we went through Q3 earnings season, inflation started to tick through some of the companies' earnings in that they signaled that trade had started to increase input costs and they wouldn't be able to absorb all of those costs themselves, so they'd have to push it on to consumers, and that drives up inflation. And then we obviously have wage growth that came in at 3.1 this month, and that's been broken out of its range. It was kind of in the high 2% range for a long time. So a 3.1 number was pretty high, and wage growth is really the missing piece of inflation that we've been looking for all year.
Right.
So upward pressure is going to continue to set expectations higher for inflation next year.
And then, of course, what the Fed does about that. Everybody's expecting a rate increase in December. What about after that, do you think?
Right. So in December, it's pretty much baked in that we're going to have a rate increase. If they don't do it in December, I actually think the market would react to that negatively because they would see that there might be some cracks forming. Next year, it becomes a lot less certain. So the Fed signals that it's going to be about 3 times. The market is maybe expecting 3 times. We actually wouldn't see them doing it more than 2, especially if we have some more market volatility.
All right.
What everybody, I think, wants them to do is react if there is market volatility and take a pause.
And very quickly, finally, a wild card in there, the Brexit talks, which just continue to drag on here. We all remember what the markets did when they voted for Brexit a few years ago. What about now?
Yeah, it's long in the tooth. The whole conversation is, well, there is a chance they're having an emergency summit in November. There is a chance that they will strike a deal there. We're hopeful that the Brexit piece becomes much less of a volatile environment. And unfortunately, that's kind of the last piece that we think is going to affect the markets. It would be nice if they struck a deal in Brexit, but there's still a lot of other overhanging risks and a lot of other question marks out there that are affecting markets more.
Indeed. Liz Young with BNY Mellon. Thanks for joining us tonight. Appreciate it.
Thank you.
Elsewhere, Cardinal Health posts a 5-fold increase in profits, and that is where we begin tonight's market focus. The healthcare services company said the growth was led by its pharmaceutical business. Even as the generic drug market becomes more competitive, Cardinal Health topped both earnings and revenue expectations, and that stock rose more than 4.5% to $56.13. Sales of newer drugs helped AstraZeneca top expectations. The CEO said today that he expects robust growth over the next few years. He said the company's drug pipeline is expanding, and he expects operating margins to rise as well. The stock gained more than 3.5% to $40.65. L Brands is forecasting a higher third-quarter profit. The company says the upbeat outlook is being driven by a strong performance at its Bath & Body Works stores. It also expects same-store sales to rise above expectations. Stock advanced 6% today to $36.96. And after the bell, Activision Blizzard issued a weak holiday forecast for both revenue and profit. Sales of the company's recently released Call of Duty Black Ops 4, they were not as strong as analysts had hoped for. The video game publisher reported results for the most recent quarter that missed estimates, and that sent the stock lower in initial after-hours trading tonight. Now to an issue near and dear to my heart, that would be genetics. A growing number of people want to learn more about their genetic history, and the rise of direct-to-consumer DNA testing kits is making it easier for them to do so. 23andMe, one of the leading companies in that business, recently held an event in New York City, and Meg Terrell went to check it out for us.
New Yorker Deborah Dedlani wants to learn more about where she came from.
My background is pretty blended, and I'm just kind of curious as to what my full background, my ancestry is.
So an Instagram post about an event for 23andMe caught her attention. The company is just one of many now offering direct-to-consumer genetic tests in a market that's exploded in recent years.
23andMe opened a pop-up in New York City to explain the information they give about everything, from how you sleep, to how your body processes caffeine, to gluten, to lactose, to even how your muscles work.
It's an example of the category's massive increase in advertising, up 63% in the first half of this year, driven by the largest companies, 23andMe and Ancestry. The market for consumer genetic tests could top $6 billion, according to Evercore ISI. But some experts are concerned about that growth and promises, implied or explicit, about what some tests can accomplish.
The benefit for cancer carrier testing, these are solid. Unfortunately, we got all these other, 90% of the field is essentially very questionable.
One independent company promises to improve kids' soccer skills. Others offer guidance for weight loss and fitness.
It's difficult for the average consumer who's uninitiated to ferret out which ones are of value and which ones are really worthless.
Helix, whose platform includes wellness tests from partners focused on diet and nutrition, says it vets their offerings thoroughly and doesn't make unrealistic claims. And despite these concerns, there's still a lot of optimism for the future of genetic testing.
All these sorts of things that we've been hoping for many years, it's eventually going to get actualized. It's just been a delay in getting there.
For Deborah Dedlani, it's about curiosity.
Now that I've seen that there's the medical side, I'm very curious about that too, so I probably will look into getting a kit.
She'll be one of millions who does. For Nightly Business Report, I'm Meg Terrell.
Coming up, a house divided. Is buying a home still considered one of the best investments you can make? Here's what to watch for tomorrow. The Producer Price Index will be giving investors a key read on inflation. The head of the New York Fed is expected to speak on America's workforce in a strong economy. And sticking with the economy, investors will get an early look at consumer sentiment for the month of November. That's what we're watching for on Friday. Well, Ford has made an investment in an electric scooter startup. The automaker is spending $40 million as part of its strategy to provide options for customers who need to travel only a mile or two to a destination. This startup is called Spin, and its scooters are currently permitted in 13 U.S. cities and campuses, including in Detroit, Denver, and Coral Gables, Florida. Mortgage rates rose this week to their highest level in nearly 8 years. Freddie Mac said that the average rate on a 30-year fixed-rate mortgage edged higher to 4.94%. Last year at this time, the average rate was 3.9%. Mortgage rates have been rising along with the yield on the 10-year Treasury note, which has steadily been climbing this year. Certainly, the rise in mortgage rates is something that potential home buyers need to consider. And as Diana Olick reports now, it's just one of the headwinds keeping some on the sidelines.
Higher home prices and rising interest rates have impacted affordability and moderated demand for homes. That from the chairman of one of the nation's largest home builders, D.R. Horton, in its latest earnings release. And that's clearly behind the drop in consumer sentiment in housing. It hit the lowest level in a year in October, according to a monthly survey from Fannie Mae. Attitudes toward both buying and selling weakened despite strong confidence in the economy. Potential buyers today said they are worried about rising rates and worried that home prices are so hot they have nowhere to go but down. So buying today may not be the best investment, at least in the short term. It's ironic because for the past few years, rising home values have made owning a home incredibly lucrative, and current homeowners are more cash rich today than ever before. Currently, more than a quarter of all properties with a mortgage are equity rich. That is, the home is worth at least twice the amount of the mortgage. That's the most since Atom Data Solutions started tracking this in 2013. And for investors in builder stocks, November to February is considered the hope trade historically. That is, buy early and take advantage of a potentially strong spring housing market. We'll see if that holds up given housing's weakness right now. For Nightly Business Report, I'm Diana Olick in Washington.
Let's turn now to Susan Wachter to talk more about whether or not buying a house is still a good investment. She's professor of real estate and finance at the University of Pennsylvania's Wharton School of Business. Susan, always good to see you. Thanks for joining us again tonight.
Pleasure to be here.
Your short answer is yes, it still is a good investment, right?
It's still a good investment if it's not an investment. If you're planning to move to stay, it's a protection against rent hikes and price hikes. And despite the fact that the market is slowing, we're still seeing rent hikes and price hikes.
But here's where I'm coming from. It's not so much a business idea as it is a philosophical one. You know, we boomers and the Gen Xers, we were always thinking about buying a home. It's part of the American dream. But millennials are a little different. You know, they're more inclined to be mobile. They like to rent rather than buy. And I know I'm generalizing, but that's really kind of been the scouting report on that generation. How does that affect this housing market, do you think?
Well, millennials have been slow to buy, absolutely, but their aspirations are to buy. They want to be homeowners, and they have been mobile. They're not as mobile, actually, as perhaps they'd like to be, but they want to be ready to take that job, and they want to get to the market which may be too pricey to own a home, but maybe renting in the short run. But their aspirations are absolutely to own, and in fact, we should see the ownership rate edge up a bit as millennials get to that age where they are settling down. And when you settle down, buying a home is still the way to go.
They're saddled with a lot of student debt, which is a hamper for them. Rates are rising right now. I mean, the first mortgage I took out in 1982 was 16 5/8%. So 5% still looks very, very low, but not for those who are used to 2 and 3% in the last decade. What role will interest rates play, do you think, in the housing market?
Well, right now, interest rates they've risen over 100 points. But they're still historically low, but mortgage rates could go higher. And that, if they go, another 100 basis points or so, this could really be a problem for housing prices. As I said, housing prices are not declining. Their rate of increase is decelerating. So it's still a time, if you want to protect yourself, that's a way to go if you're going to be in a community for the long run. Mortgage rates, in fact, because they're increasing, are going to keep people in their homes longer as they're locked in with low mortgage rates. And this is actually going to contribute to inventory scarcity, which will actually contribute to upward pressure on prices.
Susan Wachter with the Wharton School of Business at Penn. Always good to see you. Again, thanks for joining us, Susan.
Thank you. Pleasure.
Before we go, a final look at the day on Wall Street. Nothing like we saw yesterday with that monster rally. The indexes were little changed on Wall Street, but it was oil prices that got most of the attention, settling just above $60 a barrel, down 20% now since the most recent peak of just about a month ago. Finally tonight, I wasn't here last night, but it was for a very good reason. This program, which you may know is America's longest running evening business broadcast, was awarded the top public television program award for 2018 by American Public Television. The award was given to only 3 programs this year, so it is a great honor for the nightly Business Report team members both in front of and behind the camera. We were in Baltimore yesterday along with our executive producer, Rich Carolyn, accepting the award from American Public Television CEO and President Cynthia Fenneman. And we want to thank you, of course, for joining us each and every night, because without you, there is no award. That is Nightly Business Report for tonight. I'm Bill Griffith. Sue is on vacation, in case you're wondering. She'll be back on Monday. Have a great evening, everybody. We'll see you tomorrow.